Good morning, folks, and welcome back to Almus Market Mornings. As we have previously discussed in this podcast, for the determination of rate path in the US, the employment situation is an important variable, especially at a time where the Fed members are quite split. Yesterday's release of the November unemployment rate at 4.6% exceeded the market expectations and was one of the highest prints since September 2021. Domestically, rupee hit fresh lows yesterday against the dollar, testing the infamous 91 big figure. RBI also conducted a $5 billion USD INR buy sell swap. And who else better to explain us all of this than our rates expert, Mr. Pankaj Rathi? Good morning, Pankaj. Over to you.
Hey, thank you, Swaraj. In the month of December, people start looking for what will be happening in the new year. So these data sets are important, but lagging indicators. So let's look at the what happened in the data side. Unemployment data was the main focus of the market yesterday. Though headline numbers screamed weakness in employment, but there are many caveats. Data really seemed to be unreliable because its a sample size was small. There was a collection issues. There were many technical issues at play. While rise in unemployment due to temporary layoffs and re-entering work, the permanent layouts were actually lower. And only about a quarter of unemployment workers have been in long-term unemployment, which is nearly the long-term average. Now, the institute, the BLS itself admitted that November 25 data are associated with slightly higher than unusual standard errors. This is due to multiple reasons, lower survey response, and there has been weightage changes, and there are 2 month data which has been collected rather than a 1 month period. So, not reading much into the data, I what I'm looking at the even after this data, the bond yields have not fell off. So number which is 10-year is still at dealing at a basically more than 4.5, which clearly indicates that after a despite of a 175 basis rate cut in last one year and almost three and a half months, 10-year yield is actually dealing higher than where the 10-year yields used to deal before these rate cut cycles started. So not reading much into this data at this point of a time. Yes, Fed have cut 175 basis rates only because the gap between the inflation and the yields or maybe the overnight rates were much higher than they would be looking like. They would be believing that the real rates difference should be more watched rather than the actually targeting 2% inflation. Okay, so what I was highlighting, probably I've said one thing which is 4.5, more than 4.5. No, it's not more than 4.5, it's more than 4.15. So that was my error, which basically maybe a kind of when I'm saying something which I got wrong. So it's more than 4.15, which is after a rate cuts and 3.25 to 3.50 is overnight rate cut, overnight rates. So all these leading to a kind of still believing that market still not very sure where the yields are headed. It's either inflation or it's a fiscal deficit gap, which is putting up yields at a higher level. 2 year rates, which is still dealing at a 3.5%, which clearly indicates that market as of now, yields market as of now, is not ready to price in aggressive rate cuts from here. Um, Now, basically, Fed would be looking at upcoming data, and the new data which will be coming in is a core PCE, which will be available at the month end, and that will give a kind of a better picture of inflation trend. My sense is the next year, January, February, we may start looking at a first half of the year, we may start looking at a higher inflation reading because lots of spending, fiscal deficit gap will be coming into a picture. And at the same point of time, the rejob purchase program, which has been created by Powell, will also add liquidity to the system. We have overnight we have seen a stock market basically some profit taking, but it's still S&P 500, which is dealing around 6,800, which is very close to all-time high for 6,900. So no major hiccups in the stock market. We have seen a consistent downfall in DXY. Dollar index has been consistently falling, and dollar index dealing closer at 98. Clearly, pricing in is basically either US rates are stalling here or going lower, but they are not pricing any kind of uptrend in a DX uptrend in a US rates. Bank of Japan, we might expect a rate hike in this week itself. ECB rates are clearly bottomed out, and there's a possibility looking at the higher fiscal gap and inflation, diversification get pace, or maybe it can start again in the new year too. Coming to Indian markets, rupee has been a continuously beaten down. Yesterday we saw that it actually fell below beyond 91, and even despite of a very significant relative trade numbers, better trade numbers for the month of November. Market has just ignored them. The PMI numbers also printed yesterday, which is actually lower than the previous months. It's a 58.9, then a 59.7 in the prior month. Now all this put up a kind of a factor that rupee is in a downtrend. We are very close to 91 rupees, and as of now, it looks like that rupee likely to weaken further. But somehow my sense is saying that we in a shorter term we are overstressed. What can help in the rupee? Maybe there's some announcement on a trade deal coming in maybe 10-15 days. Uh, Looks like maybe first week of January, because December would be a dull period now. We can see some FII flows also, because India need some better allocation. This year we have seen a $19 billion of outflow, and which is a significant one. And can we see something from Indian authorities to attract capital flow? Very, very tough to say, but they might be looking at this also. What we also saw, there is a good amount of a demand happened in yesterday's RBI buy sell swap window. The announcement was for a $5 billion. They have attracted a bid of closer to $10 billion. Now they have accepted a $5 billion 3-year buy sell swap at a rupees 7.65 per USD, which is around 2.8% per annum premium. People who are basically selling dollar to RBI now and buying back are are basically receiving maybe a kind of a 7.65 rupees per USD, 2.8% per annum. Now, this will add more INR liquidity in coming days on Friday itself, and will stabilize the short-term markets. RBI also was in the market yesterday for providing liquidity. They conducted a variable rate repo yesterday to add on short-term liquidity, which actually the deficit has been created by advanced tax outflow. So they have added more windows for a variable rate repo. We have seen a good amount of yesterday upticks again in gold silver, $40 closer to in gold, and something around one and a half $2 in silver. All this because of a higher unemployment ratio data coming in US, and there seems to be consistent buying mood in gold and silver. Whenever they just smallest of the dip, people are using those dip to buy gold and silver. The another important indicator for global economy somewhere is faltering big time is oil market. What we saw is the WTI oil, which traded yesterday closer to 55 barrel per dollar. $55 per barrel is almost at a 4-year low, which indicates a weakening global demand in coming year. Yeah, that's all from me. Thank you for having me, and Swaraj.
Thank you, PR. And quickly summarizing, one important thing which Pankaj mentioned was unemployment rate. The sample size was small. The permanent layoffs were actually lower. And there is some reliability issue with the employment data. That's why we did not broadly see a big reaction to the employment figures. We are seeing yields still remain in the familiar ranges, so it did not seem to have much of an impact. RBI's domestically, RBI's buy-sell swap had a good amount of demand. It attracted $10 billion worth of demand against the 5 billion announced. This will add more INR liquidity starting Friday. It will stabilize the markets. And also, RBI conducted the VRR to help with more liquidity, primarily due to the advanced tax outflows. And When it comes to rupee, we have been seeing consistent weakness. It fell beyond 91, despite better trade numbers. Short term, as Pankaj mentioned, seems overstretched. It seems to be there might be some sort of appreciation on cards, possibly next year when probably the FI flows come back. That's it from us today. Thanks for listening. We'll catch up tomorrow with the fresh round of updates.